I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Ballara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you. Hi everyone, I'm Jason Ballara, and this is the Know Your Why podcast. Today I'm excited to be here with Anton Mattli. Anton has decades of experience in commercial investment banking, private equity, and commercial real estate. Quite a long and impressive bio here, Anton. Well, first of all, thank you so much for coming on the show today.
Yeah, thanks for having me, Jason.
I really appreciate you being here, and I think this will be a sort of very timely topic given the state of markets right now. So if you would you please just start by telling us a little bit about yourself, your background, kind of what got you into the space, and a bit of your career journey, please.
Sure, we'll be happy to. As you can hear from my accent, even though I've been living in Dallas, Texas now for more than 15 years, that accent is not from East Texas nor West Texas. Nope. I was born in Switzerland, went to school in Switzerland, graduated in finance, and then I joined what is known today as UBS on the investment banking side, joined them in New York, worked there for 5 years. Then I worked in Tokyo for 4 years, and then we sold a business division to a large British bank called Standard Chartered Bank. That is a major force in Asia. And as a result, then I moved to Hong Kong, and I was running the team there out of Hong Kong all over Asia. So that was all great, except that my family never saw me during that time because I was constantly traveling and in business meetings. And that's when I left banking so that I can control my life a little bit better. After that banking career, I moved into helping family offices and ultra high net worth individuals with their direct investments, primarily commercial real estate, but also oil and gas and some other investments, direct investments or alternative investments, whatever you want to call it. And that was one of the drivers why we actually ended up with the whole family in Dallas, because we had real estate projects in Texas, as well as oil and gas. And that's what ultimately brought us here. Now, with all these direct investments that we did in cooperation with these family offices and ultra high net worth individuals, we also realized that the financing side was very often a little bit problematic. No one was really providing what I felt the proper advice. And that's why we started our own debt brokerage business for commercial real estate, primarily initially just to help us and then help our clients.
So why did you think that people weren't what was the sort of wrong advice that you were experiencing, and what changes did you make to sort of address that?
Like in investment banking, I came from an institutional background, right? And as long as you're an institutional player, you have the in-house resources on one hand, but you also have lenders that are more than happy to talk with you and sit down with you and come up with solutions for you. it's a very different world once you are still a significant investor, but not an institutional level investor, where lenders tend not to be that interested because you do not provide the size of deals as well as the yearly volume of deals to make it as attractive as institutional investors do. And that, I would say, was the major challenge, that you just did not get the attention from all the lenders that would be attractive lenders when you were just buying, let's say, 2 to 4 properties per year, compared to an institutional that does many more deals and much larger deals. And as a broker, even though with these particular clients, they may still do only 4 deals per year or maybe half a dozen deals per year, when we combine all these deals and clients with others, now as a broker relationship with these lenders, we become important enough that lenders are actually listening to us and are willing to go the extra mile, which then helps our clients too. And that's really the main driver behind it, why I think we did it, and that's why our experience was much better once we kind of pooled the transaction size and had much more of a voice with the various lenders.
I mean, that makes total sense, and I guess you were sort of uniquely positioned with your background to, first of all, just know that, know the difference. I think most of us, sort of not coming from a finance background, having worked with, institutional banking and all of that, wouldn't have even realized that there was a difference. So that's a very interesting and unique perspective to have on that. So that's great that you were able to. So then your idea with peak financing is to essentially now make it so that other, smaller investment companies are able to have that same level of experience due to the, sort of pooling of resources like you mentioned.
Yes, that's right. Right. As long as deals go exactly as anticipated, I would say very often a borrower can go directly to a lender and they may still get a deal done. Very often where the situation falls apart is when there are problems with a particular deal or with a sponsor that were not anticipated initially. Sure. And that is where I think our experience and our relationships with these lenders really matter, because these lenders want repeat business from us as a broker. And with that, naturally, our clients also get the benefit of that. So the lenders will still go the extra mile just to keep a deal going, because they want to be sure that we are happy as a broker, which in turn makes our clients happy.
When you say they go the extra mile, can you give us some examples of what that would look like for, that sort of, I guess, special sort of service that they would get with your company or with using you as a broker that versus one of the other brokerages?
Yes, sure. I mean, some of the key elements that pop up in virtually every commercial real estate deal are the property condition assessment, right, where you have engineers going out and they come up with all the so-called immediate repairs and the other repairs that they feel are needed, and as well as the appraisers that come up with not just the appraised value, but also with an expense pro forma. And if you do not really have a relationship with the lender just takes all of that at face value, then communicates it with the borrower. Look, that's the way it is. And then the borrower has to live with the higher immediate repairs that may have to be escrowed, or a lower NOI because the expenses that the appraiser said are appropriate for that property are much higher, which then lowers the NOI. If you have a lender relationship where you just go in once or twice per year, the lender generally is not willing to go back and forth with the appraiser and with the property condition assessors to improve those numbers, right? With us, that's one of the involvements that we are doing virtually with every single deal to improve those numbers, which has a direct impact on less money that needs to be escrowed on one hand, but also improving the NOI, which then improves the debt service coverage and potentially with that also the loan proceeds. Right. So that's just one of many examples, but that is something that comes up in virtually every single deal.
Yeah, that makes a lot of sense. Recently, at least my understanding, and please correct me if you're seeing something different, is that most of the debt, especially in the multifamily space, is currently bridge debt. Like I've heard 75-80% of the deals are being done on bridge debt. I guess first, do you agree with that? Is that what you're seeing as well?
Yeah, I would say it's probably even higher once you focus on the major markets. When you look at the markets where most syndicators are really active in, which obviously is Texas, it's Arizona, it's Florida, it's Georgia to some extent, some of the Midwest markets too, the Carolinas. I would say there over the last 12 months, it's probably in all the major MSAs, it's probably around 90% plus rather than that 75.
Yeah.
Once you include the smaller markets, then certainly because the prices are not as high, I would say you have a higher chance that someone is able to do it with a permanent loan, whether it's a Fannie or a Freddie loan. But certainly in the major markets, I would say it's around the 90% mark.
Okay. Yeah. So I guess even higher than I had initially heard, which I guess isn't surprising with given that the price inflation and things like that has happened. When you're talking about sort of these loans and the influence that you have on the actual lender as a broker and those relationships and all of that, I would guess that really is in relation more on the bridge debt side than, for example, agency debt, because your agency debt is the government. You don't have a lot of impact there, I'm guessing, as far as what you can kind of push back on.
Actually, it's really the same, right?
Okay.
So unlike on the residential side, where it's as long as you are so-called conforming, it fits into the box, and as long as a borrower fits the box, then it's only a question of where the appraisal comes in, and then you close the deal. When it comes to Fannie and Freddie, as well as HUD loans on the underwriting side, it's really the lenders that do all the underwriting initially, and depending on the deal, if it's a Freddie, it will be submitted to Freddie, but it's still an underwriting package that is being prepared by the lender underwriting, and until it's being submitted to Freddie. With Fannie, in most instances, it's not submitted to Fannie at all. It's so-called delegated. You may have some waivers or exceptions that need to be requested, but the actual underwriting and closing is then done completely independent from Fannie. And these loans then afterwards will be submitted to Fannie. Fannie reviews those deals, these loans, post-closing, and naturally, if they feel that a lender has not done the underwriting correctly over a pool of, let's say, 100 loans or whatever, then Fannie may come back and say, oh, look, guys, I think you need to tighten up your underwriting standard or whatever it is. So there are definitely some differences from one Fannie lender and Freddie lender to others in the way they approach the underwriting. And so there are actually pretty significant differences from lender to lender. On top of that, particularly also on the Fannie side, is because they retain a risk portion of the loans. Not every Fannie lender will be equally aggressive when it comes to certain property types and certain markets. And so unless you actually know which lenders are particularly attracted to a certain market and property type, you may go to the wrong lender for a particular asset that you plan to buy or refinance, not realizing that there are other Fannie lenders that might be a much better choice. So that you even have that on the Fannie and Freddie side. Now, naturally, when it comes to bridge lenders, it is even broader because it's really like the Wild West. So every lender can have their own rules. They don't have to respond to what Fannie and Freddie set up as guidelines. However, in most instances, they are not balance sheet lenders, so they are still dependent on investors, as well as the so-called CLO market, which stands for collateralized loan obligations. So there's still in 90% plus of all cases of these bridge loans to securitize those loans afterwards, similar to what the Fannie or Freddie loan would be handled too. And naturally, these bridge lenders, when they originate a loan and underwrite a loan and ultimately close a loan, their goal is still to ensure that they actually can sell it to their investor base, right? Because most of them, they don't keep it on the balance sheet. So they always have to keep in mind to be as aggressive as they can to win the deal, the loan, but at the same time also having the ability to ultimately sell it to their investors.
Okay, well, that makes a lot of sense. That's actually very interesting, and I think probably a detailed look into how all this works that maybe most of us don't know on the surface. Well, let's dive into maybe the topic of the hour, which is, currently what's happening with interest rates in the debt market. I think that's there's a lot on people's mind. You see a lot in the media. I think there's a lot of fear about what's going to happen. Are these interest rates going to go up forever? That kind of thing. So maybe just give us a high level take of what you're seeing, and we could talk about where you think it's headed and stuff, but kind of what are you just experiencing right now on the deals that you're trying to underwrite?
Mm-hmm. The situation only from a borrower perspective has deteriorated over the last 2 months compared to where we were just earlier this year and definitely last year, right? So last year was probably the perfect time when someone wanted to acquire property with bridge loans, as well as then refinance if someone was already in the position to refinance into a permanent loan, because the interest rates were really still at really low levels, both on the short end as well as on the longer end. Were they as low on the long end as they were doing the bottom of where we were with COVID-19 in 2020? Obviously not, but it was still really attractive. So now what we have seen over the last a couple of months, where we went up on the 10-year treasury from 150, 160, 170 to now 270 a short while ago, and now we are already at above 290. So that's a significant increase. Now, naturally, one may argue, well, if I go with a bridge loan, I'm not really that worried about the 10-year treasury rate, because right now I'm only focused on the short-term borrowing, which is usually based on 1 month index rates. And those rates have gone up roughly 30 basis points, or 0.3% over the last 2 months or so. So obviously it's a significant increase there too, but I think it's still very much bearable if you take out the bridge loan. So I don't think that the short-term borrowing cost has gone up that significantly that one would say, oh, I cannot buy a deal because my going in borrowing cost is significantly higher. Now, there are two problems that, however, are driving that decision to buy a property, and that one, a lot of buyers now got caught off guard. One is with the increase in the rates, both on the longer end as well as the short end, is that the interest rate protection, right? For most of these deals, you need to buy an interest rate cap, as they're called. And the cost of those has mushroomed over the last few months very significantly. So what may have cost, let's say, $200,000 last year, you would pay probably $800,000 today. So the cost to buy these interest rate caps has gone up very significantly. So as a buyer, now you need to consider that in your underwriting, that your interest rate protection cost has gone up very significantly. And obviously that needs to be part of your underwriting. Now, another aspect that a lot of borrowers now are being caught off guard, and frankly speaking, even some lenders that were too aggressive in issuing quotes, is, as you know, right, all these bridge loans, they have the intention, all of them, these lenders have the intention that these loans can be refinanced into a permanent loan, primarily a Fannie or a Freddie, within 2.5 to 3 years. And the borrowing cost on these loans, obviously, if you had to refinance today, has gone up massively. So a lot of these bridge lenders have underwritten them at so-called debt deals that were in the mid 6% to the low 7% just a month ago, which is the equivalent of really a fixed rate of around 3.8 to 4% at best. And when we look at where the fixed rates are today, even for a large loan, they are somewhere in the 4.6 to the 5% range, right? So what does that mean? These bridge lenders now need to increase their underwriting standards, which means that the stabilized debt yield actually has to be moved up. And we already have seen that with some deals that they put under application with a much lower debt yield, or stabilized debt service coverage, whatever it is, or a combination of the two. And they came back and said, sorry guys, but now we need to increase that because our underwriting is not supporting to do it at, let's say, 7% debt yield. And naturally, they also know that they probably would not be able to sell that loan to investors with that low of a debt yield.
Yeah, makes sense. And the other thing that I have noticed that I didn't hear you mention is that even just a couple months ago, you could get usually your CapEx rolled into that bridge debt at, so if you have a 75% loan to value loan, and then you've got 100% of your CapEx rolled in there as well. I'm not seeing that right now, where you can still get maybe the 75% LTV, but you can't get the CapEx rolled in. Is that just me, or are you still seeing that in some instances?
Yeah, I would say it's more in some instances. Again, it's driven by the significant price increases that very often a deal just doesn't support to go with maximum leverage. If there is a true value add proposition there, and the lender as well as the appraiser really believe in a massive upside, then I would say there is still a good chance that you could get up to 80% loan to cost. There are very few deals out there, however, that are really like this. So it's only the case, and I agree with you, that most deals now are probably somewhere around 70 to 75% of total cost, which is the purchase price and whatever rehab money is budgeted. So there's only a reduction there in most instances on the leverage side because of that. Yeah.
And what that means from an investor standpoint is that your returns are likely to be lower, because before we could we could leverage a much higher amount, and so less investors in the deal, essentially less capital to raise. Now you've got to, if you've got to put that your capex back in there, it's going to decrease the returns. I mean, I still think real estate's the best and safest investment vehicle out there, but it is going to change the landscape of how that looks from an investor standpoint as well. Where do you see this going? What do you think happens kind of over the next 6 months, a year, whatever, whatever forecasting I know you don't have, can't predict the future, but with someone with the experience that you have and kind of the unique position that you're in, where do you see this going in the near and maybe long-term future?
Yeah, so I think in the near future, there will be continuous pressure for interest rate increases. I would say the Fed definitely will raise the Fed rate multiple times this year. For how long, we do not know. I think they are waiting until they see a cool down on the economy side as well as the investment market, particularly the stock market. But as long as the inflation is running as it has been running, I would say we definitely see the pressure from the Fed side that they are truly raising the rates several times more. And I think because of that inflationary pressure, I also see that the 10-year Treasury will go above the 3% mark, right? Now, I'm not so sure once we go beyond the 1 year from today, whether that will still, even though inflation might still be a big issue, that we still see the Fed increasing the Fed rates as well as truly doing the quantitative tightening as they claim that they're going to do, because I feel that at some point the economy will contract because of the increases, which then looking at the history, how they have behaved over essentially since 2008, that they will likely be willing to do another round of quantitative easing, which means that there will be a reduction in rate, which means more liquidity going into the market. Obviously, the result of that will be just kicking the can down the road again. It's not really solving the problem, but I think once everyone has done it around the world with the ease of quantitative easing, I think it's a very easy tool to go back to as soon as someone feels that they have to do it to keep the economy going, as well as the investment markets to keep them going.
I'm not an economist, so forgive me if some of these questions aren't up to your level, but I have heard people with the suggestions that perhaps, like other countries, we could go to a negative interest rate environment. What's your take on that? Do you think that's a possibility, a strong reality? What would that have to look like, and what do you think that means for us?
Yeah, I mean, if we are moving into a negative interest environment, I would say our economy has to be in really, really bad shape, right? Okay. So could that potentially happen? Yes, but I would say it's not something that we want to wish for, because if we enter that phase, we likely will be in a very severe recession and potentially depression, whatever you want to make the definition of what is when a recession turns into depression. But I would say that's really the only way that one would potentially have as a reason why we would turn negative.
Okay, so that is more of a, we wouldn't have negative, you don't suggest that we would have negative interest rates for a good reason. That wouldn't be something that would be, oh, that's part of quantitative easing. that's really, we've gone into a recession and we're trying to sort of save the economy type of scenario.
Yes.
Okay. Okay. Um, I mean, that's fantastic. Where do you see, so are you investing in your own deals, or are you mainly on the financing side?
Yeah, we have been investing ourselves for 30 years, right? So I've been exposed on the investment side and financing side through a lot of up and down cycles. Uh, and so obviously some of it was good, some of it was not so good. But I definitely have been exposed into the commercial space for a long time.
So, I mean, that's again, sort of unique perspective to having seen this kind of thing happen, through more than just this one market cycle. What do you see this? How do you see this all shaking out in asset prices? We've had a lot of cap rate compression. Prices have gone, a lot of people say, sort of out of control. The flip side to that is that rents are growing, sort of out of control at a high rate. And so there's argument that the income side of things on these, commercial assets will push the prices higher because of that. But then, the flip side is, okay, now interest rates are going up, the cost of debt is higher, so the prices have to come back down. How do you see that sort of playing out?
Yes, so unfortunately, there is no perfect scenario in my view, right? Have we seen massive rent increases? Absolutely. How sustainable are those? There are still a number of research organizations, including CoStar and others, that's still predicting significant rent increases. I'm not so sure that is really sustainable, because you always need tenants that are able to afford it. Yeah. Right. And I would say affordability is a key element there. Now, the argument obviously is, well, people need to have a roof over their head, which I completely understand. But I think we should also not forget that in 2019, no one really talked about such a severe housing crisis. It somehow just everyone started talking about it in 2020. And I would argue that a big chunk of that so-called housing crisis is really more driven by a shift in people moving from one location to another, and not really an overall larger need of housing, right? So I'm not an expert in, and I do not attempt to predict where we are going in terms of housing supply and demand. But when you listen to Ivy Selman, who is probably one of the most prominent ones out there, she has definitely a little bit of a different view than the majority of all the researchers have. And when you listen to her, I would say you have to expect, maybe not over the next year, but certainly within the next 2 years, significant cool down. And I would say in terms of rent growth, if not negative growth. And with that, I think you also should anticipate that the more supply that has been hitting the market, that potentially also have a reduction in asset prices there, right? Now, my view always is, when it comes to asset prices, right? A lot of people say, well, yes, interest rates go up, so cap rates should also go up. At the end of the day, yes, that is definitely the case. You always need to have a spread where the cap rate should be obviously above your borrowing cost. But I would say a lot of it is not necessarily driven by where the interest rates are, but more where the asset allocations are by the market participants. right? So what do I mean with that is that cap rates can move in a very strange fashion, and sometimes move in the opposite direction just because there is a market demand for a particular asset class. So in other words, interest rates may move up and cap rates still may come down just because there is such a massive move into a particular asset class. And that is definitely what has happened on the multifamily side, right? Now, my fear is, and I think that's what we are going to see at some point, there is everyone, including institutional investors and private investors, have such a large exposure to multifamily that there is no longer that pent-up demand to invest in more money into multifamily. So it could well be that there is a reallocation of assets from multifamily into another commercial real estate asset class, or potentially in some other asset classes, right? And I think at that point, it could well be that cap rates actually will move up even if interest rates stay flat, strictly driven by investor demand in multifamily and or in other asset classes. Now, that is my view on the actual investor demand side. When it comes to the actual borrowing cost, I think we are now at the point where, because everyone is still primarily borrowing on the short, with short-term borrowing and floating rate loans, that people are willing to pay a premium as they move into refinancing these deals. Everyone now is going to recognize that these borrowing costs are now at the level that are at 4.5% to 5%, where clearly a cap rate at, let's say, 3.5% to 4% is not really sustainable, right? So with that, I would say, regardless of where the investor demand is, at some point, the investors who are still interested in investing in a particular asset class, it's not sustainable for the long run that the cap rates are below the actual fixed rate borrowing cost. And that is what currently is the case. And I think that the market is going to correct itself there. What does that mean in my view? Asset prices will have to correct. By how much, I do not know. But I think unless the NOIs can be pushed significantly higher, there has to be a correction in asset prices.
Sure. I mean, that's all, it makes total sense. And I think I really appreciate you sharing your kind of insight on that, because I think maybe that's the question that, everyone's worried about interest rates, but probably more in the context of what is that going to do to what we're either buying or selling our assets at. And that's ultimately, kind of where the returns and what you can, sort of generate from these places is going to come into play. Well, that was great. I appreciate all of that insight, Anton. Let me switch gears here to the portion of the show where I ask each guest the same set of 4 questions. The first one is related to the name of the show being Know Your Why. What is your why, Anton? What drives you, towards success in your life?
It's really 2 pieces. One is the family, right? So I would say family is probably my primary driver. As long as the family is happy, I am happy. And the other why is that I enjoy what I am doing, and as long as I enjoy what I'm doing, then my surroundings will enjoy what I'm doing with them or for them, right? So whether it's real estate investing, whether it's providing financing advice, it's not that I do this because I have to, but because I enjoy it, right? And I would say that is really my primary why outside of the family.
Yeah, that's great. Tell us something about yourself that maybe isn't common knowledge. We know you've lived in a lot of really interesting places, but little piece of you for everybody to get to know you better.
Uh, well, I do not know how many people know that, but I was big into windsurfing, right? So everyone knows that that I'm a skier, right? But
It's required based on where you're from.
as a Swiss, you are almost required to be
Yeah.
a skier. That's right. But windsurfing is probably more of an unknown there.
Yeah, for sure. For sure. That's awesome. When people hear this and if they want to reach out to you, what's the best way to get a hold of you?
The easiest really is by reach me by email. My email is Anton, Anton, at peakfinancing.com. But I'm also active on Facebook. I'm active on LinkedIn. So if you search my name, you will find me there, and it's pretty easy to find me.
Okay, great. Final question for you, Anton. What piece of advice would you give to people? And maybe I'll change it up a little bit to normal, but usually ask what piece of advice would you ask someone getting started in real estate? But maybe more relevant to right now, what piece of advice would you give to investors out there in today's certain current market state?
Yes, I would say be patient. Don't rush to get into a deal. So that is really the key. And patience also means that, particularly if you're young, be patient and be consistent. There is nothing better to be young if you just start out today, right? We've have young adults as children. They can go through a massive amount of turmoil over the next few decades. But as long as they are patient and consistent with their investments, they will be very successful with them.
Yeah, absolutely. I love that. That's perfect. Perfect way to end this. Thank you so much. Really, really appreciate you coming on and sharing all your knowledge. I think this has been amazing for me personally, just to hear your perspective, but I think people are going to get a lot of value out of this episode and really have some important take-home messages. So thank you very much for coming on.
Yeah, thanks for having me. It was a pleasure to be with you.
Absolutely. All right. Well, with that, we will sign off.
I'd like to show you why knowing your why is the start of your journey. Without a strong why, it can be so difficult to reach your maximum potential. My name is Dr. Jason Ballara, and every week I meet with real estate investors and mindset specialists that are taking action in order to build a life according to their own terms. We will break down what drives successful people and allows them to achieve at such a high level. If you are a professional wanting to break through, or simply someone that wants to hear an inspiring story, the Know Your Why podcast is made for you.